Hi, welcome to this summary of Lecture 10 in Applied Portfolio Management on the topic of fundamental analysis. So this week we're continuing our investigation of the security selection decision. Over the last 3 weeks we've looked at different smart beta factors. Now, smart beta is a quantitative approach to security selection in that it is using screens to identify particular stocks that have systematic exposures to factors which are shown to have explanatory power with expected returns. This week we're going down a bit of a different perspective, a different angle. We're going to look at fundamental analysis, and this is the process by which portfolio managers will research and investigate individual stocks and individual companies and buy those particular stocks that they think have good prospects based on that research. So the most common approach to fundamental analysis is the top-down approach. This involves first of all looking at a macroeconomic forecast and giving the beliefs of how the broader economy is going to perform. Then moving down to examining the industry within which the firm operates, before narrowing further to look at the firm itself, its operating performance, and a method of valuing the firm and potentially comparing the valuation to the intrinsic value. So in this top-down approach, macroeconomic analysis becomes an important first step. Macroeconomic analysis is important because if we go back to our basic principles of valuation, we know that the present value of any asset or the price of any asset should be the present value of its future cash flows. Now, because price is a function of the present value of future cash flows, for a business, we need to understand that those future cash flows that a business generates are its future profits. And what is it that is the best determinant of the future profits of a business? Well, of course, it's the broader economic performance and broader economic activity across that future period. So by getting a measure of the macroeconomy, we're getting some degree of estimate of what we expect the future business prospects to be. So when we do a macroeconomic forecast, what we need to understand is the fact that macroeconomic forecasting is notoriously difficult and the economy is notoriously difficult to predict. So when performing a macroeconomic forecast, we'll be using a number of indicators, but we'll keep in mind the fact that we know we won't be able to predict the business cycle with perfect accuracy. Some of the indicators that are used to try to come up with a measure of future macroeconomic performance include real GDP growth, inflation rates, interest rates, and unemployment, along with probably many others. So once we've performed our macroeconomic analysis, we then move to industry analysis, evaluation. So industry analysis is important because it helps us to define not only which industry the firm operates, but whether that particular industry has good prospects for the future. So it's part of our decision-making process as to whether we think it's going to be a good firm to invest in. When we look at industry and evaluation, there are a range of different areas that should be addressed. We should look at vulnerability to external shocks and the business cycle. So how do we expect that industry to perform across the cycle? Is it a cyclical industry, or such as luxury car sales, or is it a defensive industry? Things like supermarkets and healthcare tend to be defensive. Next is to look at the competitive structure. So what sort of companies operate in the industry and how might this be changed? So what are the barriers to entry to competitors, particularly coming in and crowding out the firm that we're looking at? The third issue is permanence. So is it likely that that industry is going to exist in the future? A key point here is we had a lot of equity researchers saying approximately 10 years ago that the future industry prospects for print newspapers was quite dire, and that turned out to be true because of technology coming in and crowding out an existing industry. So permanence is another important consideration. The fourth factor is the phase of the life cycle. So industries go through various phases, from birth through to the growth phase, the maturity phase, and then finally stabilisation and decline. In terms of performing good industry analysis, you should identify which stage of the cycle that particular industry is currently at. Think about any regulatory and tax considerations. So not only what is the current regulatory environment, but are there any expected changes in the future? And also looking at industry financial data and performance. So as we move through this top-down analysis, going from looking at the macroeconomy down to the industry, the third step is to look at the individual firm itself and consider different methods of valuation so that we can come up with some estimate of what we think this firm should be worth. There are three key approaches to valuation. The three key approaches are, first of all, the discounted cash flow valuation, which relates the value of an asset to the present value of expected future cash flows of that asset. So an example of this that you might have seen in previous studies is the dividend discount model. The dividend discount model assumes that the future cash flow of the firm are its expected future dividends, and we take the present value of those future dividends to get the current value of the firm. An alternative discounted cash flow valuation is the free cash flow model. The second approach to valuation is relative valuation. So that is, we can estimate the value of a company by comparing it to some other comparable firm. And this is commonly the approach you might use, for example, if you're going to buy a car. So you're trying to identify what a particular car with a certain make or model might be worth. Often a first step people will employ is to go and see what other cars with that same make and model are currently selling for. That's just relative valuation. Relative valuation might often particularly be used for valuing private companies, because private companies, obviously there's no market value for you to use as an indicator. And what you might do is find a like listed company and identify what the market value of that listed company is, and assume that the private company has a similar value if the fundamentals and the accounting ratios are similar. The third method is a contingent claim valuation. Contingent claim valuation uses option pricing models in order to value the assets of the firm. So it's the view that a share, for example, because of the limited liability nature of equity, has an option-like payoff. So we can't be forced to make additional payouts beyond our shares becoming worthless if the company defaults. So because that option-like payoff of a share, the belief is, well, maybe we can use option pricing models, such as the Black-Scholes model, which uses some inputs like the volatility of the share and expected future share price outcomes to come up with a current estimation of value. Now, of these three approaches, probably the most common is the discounted cash flow valuation approach, and the most simple of the discounted cash flow valuation approaches is the dividend discount model. So we use the dividend discount model to come up with a theoretical value of shares. The application of this model is quite simple if we can assume that the share is going to pay a constant dividend forever. So there's going to be no growth. Maybe this is a company at the maturity phase of its life cycle, and we just expect the same dividend time and time again. Or alternatively, here we might be valuing a preference share which has a defined dividend that gets paid every year. In that case, the valuation is quite simple because it's just the present value of the perpetuity of that dividend. However, we know with most companies we expect growth in the company and growth in future company profitability. Hence, we expect some degree of growth in terms of the dividend across time. So when it comes time to estimating valuation using a dividend growth model for a firm that has some expected future growth, we can't just take the present value of a perpetuity. What we need to do is take the present value of that continually growing cash flow across time. So in class, what we look at is that we can identify that value as being the value of the current dividend times 1 plus the growth rate divided by the required rate of return less the growth rate. That will calculate for us the present value of that infinite stream of constantly growing dividends. Now, we've spoken about this in brief detail earlier, but it's important to come back to it. A firm comprises two elements. One is its current assets in place. So the assets in place, the current operations of the business, the assets it's currently employing, and its current operating performance. The second aspect of the value of a firm is the present value of its growth options. So this comes back to the idea that we know that the value of a stock should be the present value of all future expected cash flows. So if we're going to expect that the company is going to grow in the future, or any growth that we're now confident we know about for the future, that will already be priced in the share's current share price. So we can actually, when we perform a valuation, decompose that value into the two components, the present value of the assets in place and the present value of growth options. The way we do that is we can, if we've got a firm that's got dividends growing into the future, we can take the current price of the firm and we can say that the two elements are, well, the present value of growth options is just the present value of the firm in its current form. That is, if the firm generated its current profit every year forever in perpetuity, that would be the present value of the firm's assets in place, because its assets in place are enabling it to generate its current profit. So present value of its assets in place is just the present value of the annuity of current profits, or as a formula, that's just current earnings divided by the required rate of return. The second element of the firm's valuation must therefore be the present value of growth options. That's not something we can directly observe, but what we can imply is the fact that because price must equal value of assets in place plus the present value of growth options, if we can estimate the value of those assets in place, the difference between price and assets in place must be the present value of those growth options. Now, this is an important point to note, is that the present value of growth options can actually be negative. If you expect that the firm is going to decrease in value across the future, for example, you might be expecting that profit's going to contract across time, well, in that case, we can actually have a negative value of those growth options. So that's a summary of fundamental analysis for lecture number 10. Thank you for listening.